Let's go.
Good day to all of you, and thanks for joining this webinar on European power markets. Joel Hancock, my oil and gas colleague, and myself will be guiding you through the current energy crisis in Europe, as well as through the potential long-term solution to this crisis and the threefold challenge the European power market currently faces, namely energy supply, security of supply, affordability and price stability, and finally, acceleration of the energy transition. So indeed, what we have seen over the past few weeks is wholesale prices in France and in Germany reaching unprecedented high levels, near or above 1,000 euros per megawatt hour. So at the end of August, therefore, suggesting key disturbance ongoing across European electricity markets. So prices have landed since then to levels of 500 to 600 euros, which are still very high compared to the pre-crisis levels we were used to seeing up until Q3 2021, i.e. levels below 75 euros per megawatt hour. So how can we account for such wholesale power price surge? Well, obviously, gas prices are the main driver of this surge, and I will let Joel elaborate extensively on the current state of gas markets in Europe. And this is obviously in relation to the organization of European wholesale markets, which I will detail in the next few slides. But besides, the European market is facing a series of more or less structural issues that have either accompanied the surge in gas prices, which is the case of the surge in coal prices, and or ignited fears of potential disruption of power supply in the coming months. So to detail the few sectors besides gas that we see explaining the surge in wholesale prices, we see, as I mentioned, a surge in coal prices that have accompanied the surge in gas prices, because as we will discuss later on, coal is currently seen as a sort of unavoidable substitute for Russian gas for power generation purposes. The other point to mention is obviously the ongoing major nuclear outages in France, with 32 reactors out of 56 offline for planned or unplanned maintenance reasons at the end of August. Rising prices of CO2 emission allowance are obviously a key factor, although this factor was probably more visible until the end of 2021 than since the start of the year. A more general factor, accounting for these fears of potential power supply disruption is the gradual tightening of capacity margins all across Western Europe over the past 10 years as a result of the various generation units closures in the nuclear as well as lignite and coal technologies. And finally, this is probably a more occasional explanation, namely the very low levels of hydroelectric production seen in 2022, even in countries which were traditionally exporters of hydropower, such as Norway.
Yeah, so this is where I'll jump in and just give a broad overview of the natural gas market in Europe and where we see this going forward in the coming quarters and years. So initially, the one thing to note is that European gas prices remain well above the prior range, which really was the pre-Q3 2021 range. But what I'm going to do is talk about a few factors which lead us to tentatively say that the market may have peaked in late August, as you can see on the chart on the left-hand side. So what we have noted is a much diminished market response to Russian gas flow disruptions, most notably and recently in early September, when we had Nord Stream 1, the final 20% of capacity, not returning after that unannounced maintenance period. And that announcement that the pipeline wouldn't return occurred after the market close on Friday, September the 2nd. The market had a weekend to digest, and there was a consensus that the price would skyrocket above that prior market peak in late August. But although we did have a rally, it was well below market expectations. So there's a few factors as to why the market is becoming less sensitive to Russian flow disruption. One of the main ones actually is just the amount of gas that's already been cut. So that middle chart there is showing net inflow into Northwest Europe from Russia. And as you can see, that final Nord Stream 1 cut really almost took our flow down to zero. We just have one kind of residual gas flow via Ukraine, which is flowing about 30 MCM per day. But aside from that, we are tending to zero when it comes to Russian gas flow into Europe. So if you can move to the next slide. This is one of the other factors really that's resulting in a diminished sensitivity, and that is the fact that Europe has been able to build gas storage ahead of the winter. So currently storage facilities are about 85% full. So there was a bit of a kind of update since the slides were put together. But this has really been a Herculean effort to fill these storages. And as you can see on the right-hand chart, the inflow into storage facilities, so the net storage withdrawal negatives and injection, have been trending around the 5-year high, and there are some really loose years in that range. So this kind of has resulted in palpable relief in Europe, which explains a bit less sensitivity to Russian flow disruption. But one of the other factors is that these storage targets that were put in place by the European Commission back in March are legally binding. So just as a reminder, EU countries have an 80% storage fill requirement, 90% in Germany by the end of October. Now, really what we saw in the market was almost a limitless bid from these system operators in respective European countries to make sure that they met this legal mandate to store gas. And now we've seen this target being met, we are actually seeing, I guess, less of that kind of endless bid in the market. And so there isn't that relentless buying to meet these mandatory targets. So that has also resulted in perhaps less upside price pressure. The final point that we think is almost calming the market is the liquidity provision that has been announced throughout Europe, really, central banks and central governments, in order to provide liquidity to utilities to meet margin calls associated with spiking gas prices. So through 2022, since the Russian invasion, we have seen price spikes linked to these liquidity concerns and margin calls, and so that is also going to calm the market going forwards. If we could just go to the next slide. So this is where we look at fundamentals. Both the fundamentals that have got us into this position at full storage or relatively full storage, but also the quarters ahead. So really there's three tranches of European gas demand. You have residential, which is households, you have industrial demand, you also have power generation demand. And the really interesting thing for the European market is, despite sky-high prices, we have actually seen an increase in gas-fired power generation through 2022, predominantly due to the reasons that Ivan mentioned in the introduction. So very low hydro generation associated with droughts across Europe, but also French nuclear outages. So there hasn't been any flexibility whatsoever in the power generation stack, despite the fact that nat gas prices have been at record highs. So much of the demand reduction has had to come in the industrial segment. So we're currently tracking Northwest European industrial gas demand down about 25% in aggregate. In Germany specifically, it's about 32% down from the 5-year average. So you can see that in the middle chart there. We do expect this to continue, and what we've noted is a sharp step down in recent months, perhaps as prior hedges have rolled off, and so these industrials are now fully exposed to the higher gas prices. Perhaps they were insulated earlier in 2022. The third tranche of demand, as I mentioned, is residential and commercial demand. Is quite difficult to really model how consumers are going to react to higher prices. We did a brief sentiment analysis where we searched for save energy in various European languages, and we can see that it's one of the top search terms across Europe at the moment. And we do think that behavioural changes will result in lower gas consumption from the residential and commercial side. If we move to the next slide. So this is really where and the demand reduction, it is going to have to be seen, and as mentioned, it is a bit of so over half of gas demand in Europe is attributed to residential and commercial demand over the winter period, and our modelling suggests that we'll probably need to see about a 13% reduction, or 17 BCM, from a typical winter if Europe is going to reduce consumption by about 15%. So although we have seen kind of government measures come in to support households, in most cases we are still seeing gas bills for consumers doubling, if not tripling, in most European countries. So with that in mind, we are relatively confident that we will see at least a 13% reduction in the residential and commercial sector, which alongside the reductions in industrial gas demand should really help with getting through the winter in the coming months. So if we just move to the next slide. So this is where we're looking at the supply side of the balance, and as you can see on the left-hand chart, really the loss of Russian gas has almost been fully offset with increases in Norwegian exports and also LNG imports into Europe. So it's really interesting to think about where this extra LNG has come from. So there has been a supply element with a few new projects starting up, but also utilization at existing terminals increasing. But the interesting thing is the vast majority of the shift has come from demand reductions in other markets, and most notably China. So if you look at China's domestic gas balance, we see big increases in alternate forms of supply. So they got the Power of Siberia 1 pipeline with Russia, so imports there should be up about 20% year on year, and domestic production has also increased about 11%. So on top of demand side reductions in China associated with the zero COVID policy, the alternative supply has meant that higher priced LNG can shift into the European market. Now we are expecting this to continue. We see a big seasonal profile in Chinese gas production, so that should continue to push out the spot LNG that China would otherwise be importing, and allow quite a large LNG increment into Europe over the winter period. So if you just move to the next slide. So I've mentioned the fact that the fundamentals look okay in terms of what we can expect in an average winter in terms of the demand reductions and also the supply increase. The issue really for Europe going forwards is there is quite limited flexibility on the supply side and on the demand side if we have a cold winter. So we've modelled a composite scenario, which is the worst possible winter over the past 30 years. And really, we have quite a large range of demand outcomes, specifically in the residential sector, given the fact that we have kind of residential heating demand really being the main driver over the winter period. So in our modeling, if we have a normal winter, we end up with about 33 BCM of gas in storage at the end of the winter. If we have the coldest possible, this drops down to about 6.5 BCM. So almost the entire demand reduction can be assumed from the industrial sector and from Rescom will be offset by a cold winter. So we think the market is going to replace a Russia risk premium, as Russian gas imports tend to zero, with a weather risk premium, which is going to be highly sensitive to any forecast about cold weather, particularly in the early part of the winter. Now, it's really critical to think about the level of gas storage we end with, given the fact that effectively we have no Russian gas in 2023. We'll have to rebuild inventory again for the 2023-2024 winter, and the kind of like endless bid or the mandatory storage target dynamic will kind of re-emerge next summer as we try to get gas into storage for the 23-24 winter. So if we do end the winter period with quite low gas in storage, so perhaps the pink data series here, it's going to be much tougher to actually build up to those pre-winter targets next summer and ahead of the next winter. So it's really critical, not just for this winter, but also subsequent winters, how the weather actualizes and how that impacts demand going forwards. So if you just move to the next slide. So this is where we discuss our forecasts. So given the fact we are expecting to have demand reduction in both industry and in our residential sector, and we do expect there to be quite a large LNG increment available for Europe in our base case, we are expecting pricing to ease off. So this base case is assuming normal weather conditions and really is the gold data series in the prior slide, which was looking at the kind of 33 BCM end of March inventory target. Now, if we do get a colder winter and we exit the winter period with quite limited gas in storage, that's where we start to model a re-acceleration of pricing next summer as kind of system operators and storage operators try to meet these mandatory storage fill targets and bring gas back into storage. So in that case, we would expect pricing to dip into the first quarter, but then re-accelerate into the summer of 2023. But in the base case, where we do have a normal winter, we are expecting pricing to have peaked and will be easing off. So we are expecting an average of 142 euros per megawatt hour in 2023, which is down from about 154 in 2022. I would say that obviously these are still very high prices. The price still needs to be curtailing industrial demand, still needs to be curtailing demand for LNG and alternative markets as well. And this regime of higher pricing will be in play really until we can see demand reductions that have been announced under the Repower EU plan later in the 2020s, but more importantly, new LNG projects, which will be online sometime in 2025. So really, Europe is going to be a higher price gas market in the coming years, but we are expecting those prices to moderate slightly as some of the very specific kind of dynamics surrounding Russian gas ease off with zero Russian gas going forwards. So I'll leave it there and hand back over to Ivan.
Thanks, Joel. So why is gas currently the dominant driver of wholesale power prices? Well, to answer this question, we need to look at the way wholesale markets function, and their functioning is based on the merit order principle, which is basically the principle that prices on the electricity markets are formed on the marginal cost of the last unit of production called upon to meet demand. So if you look at Germany, quite interestingly, the two graphs show you the current situation as well as the situation prevailing over 2012, 2018, and you see very different situations. What we see now in Germany, in a situation that is likely to evolve over in the next months, as I will detail later, is the predominance of gas in the merit order. So gas being the marginal unit called upon to meet demand. It was not the case until 2018, and the reason for this is because at the time carbon prices were much lower, but also because we had, as you can see in the graph right-hand side, more capacity, power capacity coming from nuclear sources, lignite and coal sources. So as a result of the various unit closings I mentioned earlier, which have actually tightened Europe's capacity margin, what we see now is demand being satisfied by gas-fired plants rather than by coal-fired plants. As these two graphs illustrate, the merit order is actually driven by a set of three different factors: the relative price of fuels, coal and gas, the structure of supply, and obviously we have seen a change, since 2018 with the closing of so many lignite, coal, and nuclear units, in France and most importantly in Germany. And finally, the trend in CO2 prices, which obviously makes generating electricity out of coal-fired sources more expensive than from gas-fired sources. However, as I mentioned earlier, this trend is set to reverse in the coming months, with coal set to replace gas as the main price-setting fuel. So how can we account for such likely trend reversal? Well, there are three main factors that should contribute to this reversal. First of all, as Joel already pointed out, EC's main energy policy focus for the time being is on eliminating any reliance on Russian gas supply. So obviously, in this context, coal is seen as a sort of necessary evil to get rid of our dependence on Russian gas supplies. That's reason number one. Second element, which I think is quite well illustrated with this graph on slide 14, the relative trends in clean dark and clean spark spreads since January 2020. It is no longer economical to run gas-fired plants, as the gross generation margins reflected in the clean spark spreads are currently into negative territory. And with gas prices set to remain high, as Joel explained, in the coming months, we believe margins from gas-fired plants are likely to remain in negative territory in the coming months. At the same time, what we see with clean dark spreads, so the gross margin earned by coal-fired units in the German market, you see that they are in clearly positive territory, although dwindling as a result of the soft landing of power prices we have seen since the end of August. And you see that with this these clean dark spreads being clearly in hefty positive territory, it is economical to run coal-fired plants rather than gas-fired plants in the German market. And another point that suggests that we should see this trend reversal in the coming months is the trend we have already seen since the start of the year in the German market. And that's probably a difference with what Joel mentioned earlier. The trend favoring gas-fired generation was seen all across Europe, but Germany is a fairly different story, with coal and lignite fire plants enjoying more generation volumes in relative terms than gas-fired plants in H1 22. So obviously, as we just saw, the merit order is a complex and dynamic process, currently making gas the price-setting fuel in Europe, but at least in some countries, this trend is set to reverse to the benefit of coal-fired plants. Having said that, clearly with price levels reaching unprecedented levels, with continuing concerns about power security of supply in Europe, we see a series of implications from this ongoing energy crisis. To make a long story short, we see three main implications from soaring wholesale prices in Europe. First, increased government intervention. Second, deterioration of a few players' financial and operational profile. And third, surge in margin calls on organized markets, putting a strain on some utilities' cash available. So let's start with government intervention. It was fairly logical that, faced with a sudden rise in energy prices, European governments would intervene on retail or wholesale markets to limit the extent of this, the impact of this rise in wholesale prices on consumers' bills. So clearly what we have seen so far is a set of three different types of intervention on wholesale or retail markets across Germany, France, Italy, and Spain. So number one intervention was a set of direct subsidies to electricity consumers, alongside cuts on electricity levies. The second type of intervention, which was specific to France, was a cap on regulated tariff high. That is the bouclier tarifaire, put forward by the French government to limit the impact of these soaring wholesale prices on end consumers' bills. And finally, direct intervention from the government on wholesale prices to limit the price surge through a cap on gas prices factored in electricity price formation, which was the specific cases of Spain and also Portugal. So as for the individual impacts of this wholesale price trend, we see them fairly limited, but of substantial magnitude for the few names really affected by the ongoing energy crisis. So clearly, if we look at main European power producers H1 22 results presentations, looking at their EBITDA performance, we see more or less four groups of players emerging, with clear winners, but also clear losers of these trends affecting wholesale prices. So the winners were clearly those players such as ČEZ in the Czech Republic, RWE, and to some extent ENGIE with its Belgian nuclear fleets, running predominantly fixed cost generation fleets, i.e. nuclear, lignite, and renewables, which have clearly benefited from this surge of wholesale prices. Why? Because these generation units are referred to as inframarginal, so they enjoy much lower generation cost than gas-fired or coal-fired plants, but they benefit from the surge in wholesale prices. Hence, a very strong EBITDA, a positive EBITDA impact, as seen with ČEZ in the Czech Republic, enjoying an 88% increase in EBITDA generation in H1 2022. The second type of players, namely Southern European power utilities, have indeed faced reduced or even negative generation margins in their home countries, Italy and Iberia, with their gas-fired units, but they benefit from a fairly diversified business mix, both from an operational as well as from a geographical perspective. So running renewable capacities, running gas and electricity networks, being present in South America, they've been able to cushion the impact of these strongly reduced or even negative generation margins in their home countries. And then you have the two losers from the current disturbance on energy markets, namely EDF and UDIPA. EDF has faced a worst-case scenario with the tariff increase cap in France and higher volumes to be sold to alternative suppliers in France to accompany the cap in regulated tariff increases amid much reduced nuclear output in France. So to put things into context, EDF generated 361 terawatt-hours of nuclear energy in 2021, and as a result of the set of planned and unplanned maintenance works to be performed on the nuclear fleet, now expects to generate nuclear power in the range of 280 to 300 terawatt-hours this year. So clearly, having to buy electricity on the wholesale market to supply customers under the regulated tariffs, customers under liberalized offers, as well as alternative suppliers under the enlarged RM mechanism, put EDF into a very complex operating as well as financial situation, as reflected by the company generating a much reduced EBITDA in H1 2022, minus 75% relative to H1 21. And the final case is Uniper. So Uniper faces not only the impact of negative thermal generation in its home market, namely Germany, but also a squeeze on its gas supply margins, also in Germany. And worse still, because of the end or disruption of gas supplies, Russian gas supplies since early September, Uniper now faces a situation to an extent calling potentially for a full nationalization of the German utility. So that's when we look at the main power utilities EBITDA generation in H1 2022. There's also another point to mention, which has been widely discussed over the past few weeks, which is the potential liquidity risk energy companies face in Europe in relation to soaring margin calls, which also reflect soaring wholesale prices. So this is a fairly complex matter to analyze because the accounting for margin calls is complex, because also the mechanics are complex, and also because margining, working on a daily basis on organized electricity markets, you do not necessarily capture the extent of the risk in utilities H1 2022 reportings. That said, it is clear that the more utilities sell forward their electricity, which is generally the case of Central European as well as Scandinavian power utilities, the more exposed they are to margining as a result of power prices fluctuations. So having said that, it is clear that in the sector, you see very diverse impacts from soaring wholesale prices in relation to margin calls, simply because some players sell a very small fraction of their output through organized markets at long maturities. That's obviously the case of Southern European utilities. And at the extreme, at the opposite, Central and European and Scandinavian utilities tend to sell forward, up to 2 to 3 years in advance, the bulk of their output. So from this, you may easily infer that for Central European and Scandinavian utilities, there has been a clear negative impact from margining on H1 2022 operating cash flow performance, whilst for Southern European utilities, the impact has been fairly negligible in relation to these companies having, a very specific hedging strategy, which is more based on selling, on contracting electricity with final consumers rather than by selling forward their electricity production, keeping in mind that wholesale markets in Portugal and Spain only work for spot references, but not forward references. And for ENGIE and EDF, we have seen inflows actually from margin calls in H1 22, but that's mainly due to an extensive use of standby letters of credit from banks in lieu of cash collateral for their hedge positions. So amid full disruption of Russian gas supply in Europe, the energy crisis is set to continue in the coming months. And as Joel mentioned, the question is now the extent of any price surge in gas markets after the winter in 2023, based on a series of climate assumptions. So what we would expect, is record high prices and persisting security of supply risk to call for structural reforms of electricity markets across Europe. So this is the topic of this last part of today's presentation. So we will try to guide you through what is currently being considered by the European Commission and what could emerge from the ongoing energy crisis. So last September 14th, European Commission unveiled a so-called emergency plan to help the EU tackle the energy crisis in the next months, and particularly to limit gas and power supply disruption as well as price hikes until March 2023. So what's quite interesting with the EC set of proposals is that they provide for an implicit partial decoupling of wholesale power prices with coal and gas price. Why? Because among the series of measures proposed by the European Commission to be examined by the Energy Council later this month, we have, on top of a series of measures aimed at reducing electricity demand in Europe, so quite the same as what Joel presented, but on the electricity side, a clear cap at 180 euros per megawatt hour on electricity prices for what I already referred to as infra-marginal producers running renewable, nuclear and lignite-fired capacities. So this cap enables member states to take all the super profit above this cap from utilities running these generation units, and to redistribute this super profit to all end consumers, households, businesses, and industrial companies. So it's really interesting because this is the first time, to the best of my knowledge, where you see this decoupling, in wholesale prices between, infra-marginal producers and, coal and gas-fired plants. And finally, another set of measures that is quite interesting to look at is the EC at the Energy Council's request, working with the ESMA and the EBA, so the Securities Markets and the Banking Authority, on designing, emergency liquidity instruments to help mitigate risk of margin call ignited liquidity crisis in the energy sector as a result of these margin calls that have been soaring on the back of soaring wholesale electricity prices. So there's no concrete elements, coming out of EC's communication. What we note is the EC, the ESMA, and the EBA currently waiting the potential enlargement of the list of potential collaterals in organized energy markets, in particular bank guarantees. So that's, I think, quite interesting because it shows that there could be structural reforms in the functioning of organized energy markets to prevent any margin call ignited liquidity crisis. So clearly, the measures I've just described, are meant to help the EU face the winter season and to avoid any, power supply disruption or skyrocketing wholesale prices, eventually affecting end consumers. Beyond that time horizon, the EC is clearly committed to considering a set of more structural or long-term reforms on electricity markets. So there are lots of avenues to be potentially explored, some of which are already in place, as I will detail, or are in the process of being discussed at the EU Energy Council level. So this slide lists a series of measures that are, could be considered from one extreme to another, from, I would say, a very market-oriented functioning of electricity markets, namely keeping the merit order, but accompanying, I would say, the preservation of the merit order with strong demand reduction measures, which is basically what the EU is currently proposing to tackle the energy crisis during the upcoming winter season. And at the other extreme of the spectrum, you see full regulations of the electricity market with a market that would return to a monopolistic organization. And so what you see with all these measures is that they all have their pros and cons. And clearly, when it comes to, sort of midway approaches to reforming the merit order, you see that it's the case of the pay-per-bid capacity auctions and wholesale markets, or the marginal cost weighted average based merit order. You see that all these measures have their pros and cons and have not so far, attracted strong political support, at the EU level, at least at the Energy Council level. Also, the cap on gas prices used for electricity generation, which is currently in place in Spain and Portugal, has been fairly effective in these two countries, but is costly. That's the number one element. And the second element is that it has been fairly effective because electricity markets in Iberia enjoy limited interconnections with their neighboring markets. So essentially, Spain and Portugal tend to work as electric peninsulas with limited interconnections, which obviously make any member state intervention more effective than in a more open electricity setting. So clearly, what we see from these various measures is that full adherence to the merit order is probably the most consensual solution for the time being, but it does not solve the main issue of marginal based electricity pricing, providing limited incentive to invest in technologies with high fixed cost, such as nuclear, so provides little incentives to invest. At the other extreme of the spectrum, return to a monopolistic market probably would respond to the need for a longer term approach to energy investments, but obviously currently enjoys very limited political support at the Energy Council level. So what we believe is that a sort of third way combining both approaches could emerge in the coming months and years. So the idea is for European policymakers to maintain, I would say, the functioning of the wholesale markets based on the merit order, but accompany, I would say, any fine-tuning of the organization of organized markets with the acceleration of long-term bilateral contracting schemes that are currently in place in Europe. If you think, for instance, of capacity mechanisms or capacity payments for dispatchable generation units, namely gas-fired plants, being able to preserve the operation of plants that were not economical to run, at least until 2018 in Europe, but which were pivotal in preserving, I would say, the balancing of electricity systems. That's the number one bilateral approach that we think should be preserved or even expanded in Europe. The number two bilateral contracting is between power producers building new nuclear reactors and governments, simply to provide sufficient visibility on these generation assets cash flows for the project sponsors to initiate costly and painstaking construction projects. You see a good example of bilateral contracting in nuclear build in the UK, with an approach currently switching from CFD contract for different based contracts, as for Hinkley Point C, to a more RAB-based or regulated asset base based scheme for the upcoming construction project at Sizewell C in the UK. So that's the number 1-2 approach, which could be particularly meaningful to initiate new nuclear build programs across Europe. Obviously, for those countries that want to rely on nuclear to decarbonize their economy or their existing generation fleet. And finally, we believe that this bilateral contracting would be extremely powerful to accelerate the development of renewable energies in Europe through the accelerated development of green corporate PPAs, to leverage the ongoing deflation at work across renewable technologies across the globe, particularly solar, PV, and wind. And obviously that would be at the benefit of corporates, particularly manufacturing companies, which would be then able to access competitive but also locally produced and low carbon energy. So to wrap up this presentation, there are a few messages we want to draw your attention to. Given, I would say, the likely continuation of tensions on the European gas markets, electricity prices will remain high in Europe this winter, and most likely in excess of 300 euros per megawatt hour. Second, we believe that all the measures proposed by the European Commission in its energy emergence package should help tackle some short-term issues of supply continuity and market liquidity. So for the coming months. Beyond winter 2022-2023, a change of paradigm in the organization of the electricity market is probably needed to provide sustainable and consistent responses to the threefold challenge of energy security, climate change, and energy decarbonization, as well as energy affordability and price stability. So obviously in this environment, bilateral contracting is called upon to play a key role in supporting the operation and development of generation units, meeting this threefold challenge. So instead, of a complete regulation of electricity markets, our scenario is more on an increased involvement of governments across Europe to support and take part in the development of bilateral contracting. So I think these remarks conclude our presentation, and we are now ready to take on all your questions in the next 15 minutes. Thank you very much for your attention.
Yeah, so a few of the questions are looking at gas market dynamics specifically. So if I just have a look through. Okay, so the first one is talking about LNG export capacity in the US and how that is going to help in the coming winter season and the next winter season. So what we're seeing with US LNG is obviously a big drive to increase capacity. And actually, a lot of projects which were almost floundering have now had a renewed impetus with effectively new agreements being signed to underwrite the terminals with capacity commitments. In the near term, we're not seeing a huge increase. So we have the Calcasieu Pass project from Venture Global, which is operational, but it's being brought on incrementally in a modular setting. So that will ramp up, continue to ramp up to full capacity over the winter. And then the other potential game changer isn't a new project, but it's the Freeport LNG terminal, which has been offline really since the start of June when we had an explosion at one of the gas gathering lines. Now that project is due to restart in November, but it's unlikely that we have full capacity back until about March or April. So probably not enough, not in time for this coming winter, but that will kind of help next winter as well. really we're looking more at a 2 to 3 year timeline for new projects out of the US rather than, you know, very short term. So apart from, you know, the incremental ramp up of the Calcasieu Pass project and Freeport coming back, we're not seeing huge incremental volumes in the short run. We are seeing more of a trend towards modular projects though. So this typical, you know, like 3 year FID first gas cycle might not be quite as relevant in the coming market if we do have kind of quicker development, permitting, FID, etc., to get more gas in. But at the moment, we're not expecting huge amounts of new volume in the coming winter or next winter either. There's another question just about Nord Stream 1 and talking about whether the market is sensitive to, you know, any tension with Russia, given the fact we've seen flows drop to zero. So I think we have almost not a decoupling of what's going on with like Russian macro with European gas, but we're getting there as flow tends towards zero, because the weaponization of direct gas exports is a lot less impactful because we've already had so much cut. I would say going forwards, the risk is probably more on the other side if we do have a rehabilitation of Russian gas in Europe, if there was some sort of you know, ceasefire agreement, some kind of political deal. I mean, it seems very far away where we are right now, but often with these things we do see cold commercial logic prevailing. So that would probably be the risk that I would see, given the fact that weaponization has effectively run its course with European imports of Russian gas basically tending towards zero.
There's one question on new LNG terminals, John, you can take.
Let me just find it. Okay, yeah, so this is the new FRSUs in Germany, so the new import terminals. So in terms of what's going to be operational for the coming winter, it's about 30 MCM per day, which isn't a huge volume. It's not really going to move the needle. And we also have to think about how the LNG market isn't increasing supply capacity. I mean, the capacity for Europe to import that LNG is going to increase, but we're still competing for the same number of cargoes. What is going to be noted, however, is a more efficient, shall we say, calibration of how gas flows into Europe via kind of LNG import terminals. So effectively what we're going to see is kind of less utilization perhaps in the UK and Spain, where we can't get this gas further into Europe, into Germany where it's needed, given that Germany are basically on the end of the Russian pipeline. So Germany will be able to import that gas directly. And so it won't move the needle in terms of replacing Russian volumes, but that gas will be more efficiently allocated, shall we say. And so although it might not impact pricing on an aggregate level, when we dig down into the different basis prices within Europe, that's where we might start to see an impact.
There's one question I can take. Thanks, Joel, for this one. There's one question I can take on renewable energies. The participant is asking whether this cap on infra marginal technologies could affect the development of renewable sources. We don't think so, simply because if you look at the way renewable energies are remunerated in Europe, there are basically three ways, either through contracted PPAs. As I mentioned, it's a bilateral contract with an off-taker at a fixed price. So obviously setting a price on wholesale prices would have no influence on those bilateral contract under private terms. And prior to 2017 in Europe, most renewable assets were remunerated under feed-in tariffs. And so I'm not aware of any feed-in tariff, at this level, at the level of the suggested cap. So obviously there's no reason for this this mechanism to be amended. And finally, where we could see an impact is on the feed-in premium mechanism that is in place for assets commissioned in Europe since 2017, because this feed-in premium system works as a floor on prices. So whatever the wholesale price, the project developer gets a guaranteed price, but obviously can retain any amount in excess of this floor if wholesale prices go up. So obviously, yes, there could be a sort of cap on the earnings these plants or these assets commissioned since 2017 can generate. But the important thing is we're already at very high levels, and I think that's the key point. I think the European Commission has set a price cap at a level such that this won't discourage any project development of renewable sources all across Europe. Probably to give you an idea, if you think of a country like Spain or Portugal, new solar sources can be deployed at prices, below 30 euros per megawatt. So I'm not saying these conditions prevail all across Europe, but it gives you an indication how generous, I would say, the price cap can be for renewable energies in Europe, in the most endowed regions for solar and wind power.
There's one question on LNG pricing globally. So really, I mean, we're expecting the LNG price to effectively be driven by dynamics in the European gas market, given the fact that effectively both Asia and Europe are competing for cargoes. And so really the biggest driver of LNG prices at JKM is going to be the price of European gas, given the kind of international competition element. Ivan, there's a question on French nuclear capacity recovering back to normalized levels.
Yeah, I need to. Could you read it, please, Joel, because I can't find it.
Yeah, so when do you expect French nuclear plants to come back to full deliveries?
Well, interestingly, we won't get back in the near term to full capacity in France. I mean, full capacity is put by EDF at 400 terawatt hours annually, and in 2024. EDF should reach back a level of, say, 330 terawatt hours. That's assuming, there's no unplanned maintenance work to be performed on nuclear reactors. So there's still a long way to go for EDF to reach back its normative nuclear output levels. We are just, in a process, in a sort of normalization process where we expect the corrosion issues to be solved, obviously limiting the extent of the unplanned outages in France, and enabling EDF to reach back, levels that are more commensurate with its long-term targets. But obviously, if you look at EDF's, nuclear production targets for 2024, we're not back there yet. Probably one question, and that could be probably the final one, that was on, I think, an interesting one on electricity prices. Let me see. Yes. So one participant asked why we could have very high electricity prices. And obviously prices above the price cap. I think an important point to mention, to make things clear, is that the price cap would work on infra-marginal generation units. So those plants run on gas or coal will be continuing to set the equilibrium price on wholesale markets, hence potential prices way in excess of the cap. And as I said earlier, we are expecting electricity prices, because of the influence of coal and gas, to remain way above 300 euros per megawatt hour. But the cap really applies to infra-marginal generation units. And with this cap, obviously, all the super profit earned by the owners of these units, are to be rechanneled to consumers, but only for these generation units. Well, I think we are reaching the end of this webinar, but thank you very much for your participation and questions. Joel and I remain available for any further question you may have, so feel free to contact us by email following this presentation. Many thanks to all of you.
Thank you for attending, everyone.